Hi everybody, you've got Garrett and Matt with Bring Home Denver, and today we're speaking with Matt Stewart with Northwestern Mutual, and he is a certified financial planner. Thanks for coming today, appreciate it.
Yeah, man, I really appreciate you having me here.
Absolutely. So we talk a lot about investing in real estate. We wanted to talk today about permanent life insurance because really there's two vehicles after you've maxed out all of your other investment opportunities that are offering tax avoidance and really wealth preservation. And obviously we talk a lot about real estate. There's the 1031 exchange, there is leaving property to your children without them having a step up in tax basis. The other vehicle that we want to talk about today is permanent life insurance. So Matt, why don't you tell us a little bit about what permanent life insurance means and why they should care about it?
Yeah, thanks, Garrett. I appreciate the opportunity. So yeah, I would say that most of the people that I work with end up getting to the point where they're maxing out their qualified plans, whether 401ks or IRAs through work, and they're looking for another tax sheltered place to save. And after all, the biggest expense we all face as investors are taxes. And so finding a way to manage that allows you to get, a higher after-tax rate of return without really taking on a lot of incremental risk. And so once you get to the point where you're maxing those things out, a well-structured, permanent life insurance policy through a really like a AAA rated mutual company can be a great place to, park some of those dollars. And I think it's important for people to understand the pros and cons of those and understand what the potential opportunity costs are. But, what we typically say is that, a lot of times the cost of the insurance is less than the cost of taxes. And so when you're trying to compare other safe dollars to what a permanent insurance policy might provide, it's a really attractive option. And I think to Garrett's point, a lot of people I work with are entrepreneurs or business owners, or they like investing alternative investments in some capacity. And so having a place to build up capital that's not taxed, you don't get a 1099 each year for having money in a life insurance policy. And so building that capital to have liquidity to go do a deal, invest in a real estate project, buy a business, or even just have an emergency fund or a rainy day fund for the inevitable ups and downs that life throws at you.
So you're saying I can pay into my life insurance money and then I can pull from that, is that right?
Yeah, typically what we recommend for people is when they're younger that you pay your premium annually, and there's different ways to structure those premiums depending on the goal of each individual. Ideally, you'd want to put in what are called additional premiums to overfund the policy so it builds more quickly. But then, to your point, you can borrow against the policy and then use it for investing in real estate or a business or something like that. And then ideally, what we encourage our clients to do is replenish. Prior to retirement, we would encourage you to borrow. You make an investment and then pay it back with the cash flow from that investment, or when that investment sells or you flip it, pay it back. And then, once you get to retirement, at some point, if you then need capital out of it, you can decide if you want to pay it back or not. And that really depends on your legacy goals, your tax bracket, and other assets that you might have in your balance sheet.
So much like properties that I've got the payment paid down on quite a bit, I can borrow from that equity and then pay myself back out of that. You can be your own bank.
Yeah, exactly. Yeah, and I think what a lot of people that we work with appreciate is they've usually done relatively well financially, and they'll have maybe a large stock portfolio in addition to real estate and other things. And think about it: if you were going to take money, you needed $250,000 for a down payment on a property, and you have $500,000 in an investment account. Well, now you got to pay tax on the gain of that to come up with that down payment. Whereas if you could borrow at a very low, attractive rate, that's typically a better or cheaper cost to you than having to pay the taxes and then not missing out on the potential appreciation of the stock market on those other assets that you own.
Love it. And then in the unlikely event that I ever die, that gift will be left to my kids tax-free, is that right?
Yeah, so the death benefit is tax-free. In most cases, if it's in trust or something like that, then there can maybe be be a little bit challenging. But for the most part, death benefit is tax-free to your family. And so, there's a lot of nuances to how that could work when you borrow, but typically if you do borrow from the policy, that can reduce the death benefit slightly. But overall, yes, if that money is then passed tax-free to your family. Just like Garrett mentioned, getting a step up in basis in real estate or stocks, those are usually much more efficient assets to leave behind to your family versus like a pre-tax 401k or an IRA, because then those have to be distributed over a shorter period, and then they're added to the income tax of the beneficiary. So, typically we recommend like Roth IRAs, real estate, life insurance are probably the best asset transfer tools or inheritance tools.
Awesome, thank you. And so again, if you've maxed out all of your traditional investment vehicles and you're unsure about real estate, I want to point you towards Matt. He's brilliant at what he does. He's going to take great care of you, and he's going to help you just protect a little bit more of your assets from taxes and preserve a little bit more of your wealth. So thank you for speaking with us today.
Thanks, Garrett. Appreciate you having me.